So you can see in 2025, the value of this year's earnings as a component of the current stock price is tiny. This is why I often say, I don't care what Tesla reports this quarter, next quarter, the quarter after. It doesn't matter, because what matters is the present value of those earnings 5, 6, 7, 8, 9, 10 years out. Nothing's perfect, and that's why so many people use PE as a shortcut. And I'll show you very clearly here in a minute why that's so bad, particularly for high growth companies. But what I want to show with this chart is it's the sum of all these blue bars that determines the present value of Tesla stock today, based on the model that we presented. Now, you may disagree with the assumptions, fine. Change the assumptions, run the model, and see what the present value is. And we're going to do some of that here in a minute, just to show people what some differences could be.
Tesla stock is misunderstood, and today we get the chance to speak to a Tesla retail analyst who'll share his research and break down why. This is a must-watch show for serious Tesla investors. He'll review Tesla's valuation from 3 angles: sum of the parts, PE ratio, and discounted cash flow. But here's the truth. Applying a standard PE multiple to a high-growth company like Tesla is just dumb. We'll also explore what expectations are already baked into the stock and whether the market is pricing in reality or missing the next wave entirely. The most important questions answered today. Cern Basher is a chartered financial analyst running his own investment advisory firm called BrilliantAdvice, providing wealth management services. Welcome, Cern. I think you outdid yourself today. This is a big show. It's going to answer a lot of questions. And just by talking to you ahead of time, I realized there's even a few things that I thought I knew that was wrong. And you'll forgive me because it is kind of in the nuances. So thank you so much, Cern. I appreciate you taking the time to put this all together today.
Yeah, hi Herbert. It's good to be here. We talked about this before a few months ago, and there's a lot of nuances, a lot of complications when it comes to valuation. So let's dive a little bit deeper into that today.
Yeah, this is a big one. I really appreciate you doing this. Like I said, so this is Tesla's business valuation, and it's a waterfall. Is that what this is?
Yeah, what's the metaphor here is that we're going to be turning on different revenue streams, different waterfalls of cash flow.
Okay, gotcha. I can already see where your bias is of the different kinds of valuation models. So it looks like that we're going to go through business line models, some of the parts valuation. So some people, I think Dan Ives as an example, as a Tesla bull, he appreciates the sum of the parts valuation model. Total company valuation using PE. So many institutional analysts, they always cite PE ratios as the way to value a company. And then, of course, the ones I know you really like is discounted earnings cash flow, bringing that back to present day. PE ratio valuation is dumb. You'll explain why you think that, and what is the market pricing today. So once we go through all this, you'll come back and explain to you what you think the actual price of Tesla is today, right?
Yeah, and as with a lot of things that I do, we're going to kind of build this up part by part, piece by piece, and kind of get to some final conclusions towards the end. So a little bit of patience might be required here in the beginning as we just set things up.
Okay, let's go.
So as we all know, Tesla is an auto company. They make cars. So if we looked at that line of business for Tesla and just treated that as a separate company, you might come up with some kind of valuation methodology like this. Now, again, what I'm showing here is a very, very shortcut approach. You could get into a lot of detail about each vehicle model, the pricing of each, the margins on each, and all those different factors. But I'm just trying to distill this into something that's manageable for this show. Okay. So if we look at the number of years on the leftmost column, we've got 6 years of history there, and it shows the number of EVs delivered there in the second column. And then everything from 2025 on is projected, that's in green. And so if we make some projections about how many vehicles Tesla makes, let's say 1.75 million this year, 2 million next year, 3 million, et cetera. Now, I realize that people can quibble with these numbers. I'm not presenting these as my strongly held guesses in terms of how many vehicles Tesla's going to deliver, but just as inputs into a model to be able to show people what the impact on valuation is. You can see the annual growth rate there in the third column. So after a couple of years of flat to no growth in 24 and 25, we're expecting in 26 a resumption of EV delivery growth. And we're expecting a couple really strong years in 27 and 2028. You make some estimate for average selling price. You get to then the revenue line in the next column. And then you make some estimate for what you think the profit margin might be. And again, I've just kind of done this very simply, starting at 15% and growing it to 20% over time. This is net profit, not gross profit. This is net. This is after all expenses. And then you get to the net profit in dollars. So we're looking at about $11 billion of profit from the auto business, perhaps in 2025, and growing up to about $87 billion by 2035. Mm-hmm. Now, what's typically done here when you get these numbers is people apply a PE ratio to it. And how do they arrive at the PE? Well, they look at comparable companies. What are other auto companies getting as far as a PE? And you might say, okay, Tesla is similar to those companies in these ways, but it's very dissimilar in these other ways. Therefore, I think the PE should be higher for X, Y, and Z reasons. And so if you say, well, there's going to be a lot of growth in future years, Tesla's kind of gone through a little bit of a dip right now. Let's give them a higher PE than what would normally be warranted by looking at the auto industry. And if we applied a PE of 50 to the auto business, you would get to a current valuation today of about half a $500 billion, $538 billion. Now, some people might not be as charitable as I would be there. They may say, well, no, the PE should be 25. In that case, it might be 250 billion valuation on the auto business. So when you use a PE ratio, you get to a point where you can kind of drive a bus through the different numbers. The numbers can be so different depending on what assumptions you make about what the appropriate PE ratio is. Now, what I did in this model was bring the PE down so that by 2035, I'm using a ratio of just 15. And at that point, I get an auto business line valuation of about $1.3 trillion if they're making 14 million vehicles, selling 14 million vehicles at that point in time. So that's sort of a method that you would use to build up a valuation for a business line. Again, you can make this way more complicated than what I've done here. I wanted to show this just kind of on one page. The right way to do this would be to build it up by every single product in every single country and every single market and build up the model on that basis. But that becomes very complicated very quickly.
Yeah, I know you said that the PE ratio is so variable and it impacts it basically whatever you decide the PE ratio is supposed to be, that becomes your market value. But if you just look at this, so 538 billion, let's assume that that's about 50% of the current valuation of Tesla at around $1 trillion. So instead of $310 of the stock price, it should be half of that. So $150. So that's really what the auto part of Tesla's could be valued at, is $150 of the 300 plus is auto. And that's because of that, and using a PE ratio of 50. And again, who's to say that that is the right PE ratio, but that's based on the current numbers.
Yeah, it depends how you felt about the other parts of Tesla's business, and we'll get to those in a minute. But if you were optimistic about autos, let's say you didn't think that RoboTaxi was going to happen. Let's say you think that's just going to be a dud. But you do think that the full self-driving software will be something that Tesla licenses or something like that. Then you might say, well, the auto business actually does have a pretty bright future. Now, I realize that those two statements are a bit incongruent. If RoboTaxi doesn't work, then probably FSD is not going to be licensed by anybody. But you could have different points of view in terms of where you see Tesla's auto business growing. And there could be a significant software component to the auto business that could be reflected in these numbers, right? And so for that reason, you might say, yeah, I'm willing to assign a relatively high PE today because I think the margins will improve and I think the growth will improve over time.
But on the other side, the people who say that it's already built in, the potential growth of RoboTaxi and robots, it's already built in because of the stock prices at 300, but the auto business is only valued at 150. You already built in some value to potential future.
Yeah, and we'll get to that in a minute when we start looking at some of the parts.
Sounds good. Okay.
So the next one we can take a look at is Semi, and this is a new model. I just built this. And this is a new, business line within autos. And I built it separately because I think that could look a little bit differently. So these are some very rough numbers in terms of Semi production and sales. Basically, producing 20 this year. I don't know the number. It might be more than that on their pilot production line. But as they start to ramp up the factory next year, which is supposed to have a 50,000 truck capacity, I put 5,000 in for next year. And then from there, it ramps up to capacity. And then I've also assumed that they'll build another factory at some point and increase capacity over a period of time. Okay. And so you make assumptions, again, for the average selling price, starting at about $280,000 per truck, going down to about 200 over time. And you get to revenue by 2035 of about $24 billion. Let's say they have a 30% net margin, which, if you include the autonomy part of Semi, I think those are reasonable numbers, right? These semi trucks will be autonomous vehicles as well. So there's a big software component to this business line. And I get to net profit of about $7 billion by 2035 and a business value of, let's say, 100 to 110 billion. So again, really rough numbers. I could easily make a case for much higher numbers than these, but this is a good start.
Mm-hmm. So
Okay.
just semi alone will hit the $100 billion valuation, which is, where we're at now. It's not where we're at now, but
No, it's not where we're at now. The
significant.
valuation of semi would be pretty small based on this because there's no revenue, there's no earnings, or very, very little.
Yeah.
So the valuation on a PE basis would be little. And again, this is another example why, as we've teased in the beginning, that PE ratio isn't so good because it doesn't really factor in future potential.
Mm-hmm.
So if you have a business with no revenue and no profit, you can apply a PE of 1,000 to that and you still get a business value of 0.
Mm-hmm.
So you do have to look beyond sort of the current year to say, okay, what could this business look like? And then discount those earnings back. And that's what we'll do in a minute. Okay, so the next business line is an existing one, service and other. This is supercharging. This is the service business, maintenance for vehicles and so on. And so I get a business value here in 2035 of about 150 billion on earnings of about $10 billion with a PE of 15. And again, there's a lot of different assumptions that go into this in terms of the growth of supercharging. Supercharging growth will relate a lot to what your expectations are for RoboTaxi. So I've tried to be very conservative here with those numbers, but this is also a pretty attractive business, just on a standalone basis. And then one that we talk about a lot is energy. This business, I get to a valuation by 2035 that's about the same as the auto business, about 1.3 trillion.
Mm-hmm.
Perhaps today this business might be $100 billion business in terms of its valuation, if you just look at where it is today.
Yeah, how come this sounds a little bit too conservative? I've heard other people who did analysis, and they're thinking that they're going to get to 1.1 trillion, which is where we are today, by basically 2028, 29. Like I can see here that you only put a 15% margin. I've seen others put at 30%.
Well, this is net margin, keep in mind.
Oh, okay,
so they're probably talking about gross margins.
Mm-hmm.
Okay, so the difference is there. The other thing too, I've got energy deployed going from 31 gigawatt hours last year to 3 terawatt hours. So a 100x increase in the volume, but I have pricing getting cut in half.
Yeah.
Right. So they're going to deploy a lot more energy storage systems, but they're going to be hurt on the pricing side. And so the revenue, goes up by a lot. It goes from about 10 billion to 450 billion. Right. And the profits of 2 billion to about 68 billion. So it's significant growth in the business. And then it all comes down to what PE you want to apply to that.
Yeah. Okay. Yeah. The number I was looking at is here, 960 by 2030. I was hearing it was going to be 2029. Now it's more likely to be 2030. Okay.
Yeah.
But basically, the point here is that by 2030, which is 5 years from now, whatever we're doing now, which is $1 trillion, energy alone should be able to get us there.
It certainly could. And it could go well beyond that, depending on how quickly they ramp up their production facilities.
This is the number. It's $100 billion of revenue, which is what we're getting today.
From the auto business, yeah.
Yeah.
Or from the
just
company.
Today, we're already getting $100 billion per year.
Yeah.
And so energy can hit the $100 billion by 2029.
Yeah, no, I would agree with that. And then related to energy, and I built this separately as a model for AutoBidder. There's a big AI component and potential for Tesla's energy business, as represented here by AutoBidder. The numbers that are shaded in gray come directly from the energy model. And then we're taking a look at the cumulative storage deployed and then figuring out how much profit we think the AutoBidder is going to get on that installed base, building up a model. I get to about $30 billion in profit by 2035, apply a PE to that, and you get about $1 trillion business just on AutoBidder by 2035. Mm. So this is a significant opportunity for Tesla long term, and one I think that very few people really factor in, if at all, in their models.
Exactly. Yeah, exactly. That was the point. $1 trillion of valuation. Significant. That's a lot. Just AutoBidder alone.
It's a lot. Yeah.
Yeah.
And we'll see. We don't have a lot of information about this business at this point, so we'll see. This is a little bit of a stab in the dark in terms of what this business potential is, but this is at least one attempt to do it. And then we get to the RoboTaxi business. Again, the numbers in gray come from the auto business in terms of the EVs delivered, and the question is then, out of those cumulative EVs sold, the numbers in pink represent the autonomous fleet size. So how large will the fleet be at different points in time? We had higher numbers than this when we first did this about 6 months ago. I've backed off the numbers for 2025, backed off for 2026, and so on. But at some point, this will ramp aggressively to fairly large numbers. And you can see that by 2035, we get to a $21 trillion business valuation just on RoboTaxi. Now, I applied a PE there of 50. So if you want to quibble with that and say it should only be 25, then it's a 10 or $11 trillion valuation. That's fine. But this is a very profitable business, and at this point, still growing nicely. Even though you can see there in the last couple of years, I've only got, I guess you can see that the autonomous fleet size has gone from about 20 million vehicles in 2033 up to about 27, 28 million by 2035. So still growing quite nicely at that point. Okay, and then the business that just eclipses them all is Optimus.
Oh.
Okay. And so I've got the production of humanoid robots there in that one column. So let's say last year they produced 10. Let's say this year they produced 2,000. And then ramping to 50, 500, 2 million, 6 million, 12 million, and on up to 100 million by 2035. Okay, so the growth in this business is phenomenal. The profitability potential in this business is also phenomenal. We're talking about over $4 trillion of potential net profit on a fleet of 285 million robots.
That's isn't that NVIDIA's valuation right now, 4 trillion?
There you go.
And the profit itself is 4 trillion.
Yeah.
Yeah.
Okay. So in a minute we'll discount this and say, okay, my numbers are pie in the sky. That's fine. I happen to think these are ultimately pretty conservative. Maybe it doesn't happen quite as quickly as this, but Elon has talked about aggressively ramping this business at some point. And so just to drill down on that a little bit, let's compare Optimus deployments with the numbers that we have for auto production and auto deliveries on the next page. So when you first look at this, you see the bot deployments there in blue is massively, out accelerating the auto delivery number. And you say, oh my gosh, this seems crazy. How can they produce 100 million robots when they're only producing, let's say, 14 million vehicles a year? Well, the reason is that a robot is probably about 1/30th of the weight of a car. So if you go to the next page, let's say...
Wait. Yeah, before we go there, was it 14, how many million per year for auto delivery here? 14
about
million?
14 million, I think, was the number that we have.
Yeah, that's not crazy because Toyota today, don't they make around 10, 12 million per year already?
Yeah. And in an autonomous world, there'll be a lot of need for cybercabs. So that kind of production is not crazy. Maybe they're only going to be selling 1 million vehicles a year, but they could be deploying 13 million into their fleet. Okay, so what I've done here now is say, okay, bots are smaller in weight. Therefore, you should be able to produce, let's say, 20 bots for every car that you make.
Yeah.
So when you adjust that, when you take the bot numbers and divide them by 20, suddenly the bot production doesn't seem so crazy relative to the number of vehicles that Tesla's able to make, right? Remember, Tesla is is very proficient at manufacturing things at scale. So if we adjust the bots for less complexity, less size, et cetera, it's just easier to move bots around a factory than big, heavy cars. They should be able to make a lot more of them. So 100 million bots, it doesn't seem crazy to me by 2035.
Not at all.
And Elon has made many statements about this as well. He plans to ramp this up in a massive way. Okay. So let's take all that together now. We've just looked very quickly at all the different business lines. Let's look at the sum of the parts valuation. So what we have here is the valuation that comes from each of the models. So you're pointing there to autos. By 2035, we get to that 1.3 trillion in valuation. Okay, and then we've got semi next to it, 100 billion. We've got another 1.3 from the energy storage business. Services and other 150. And then we've got RoboTaxi at about 21 trillion. We've got Optimus at about 214 trillion. We've got AutoBidder at about 1 trillion. And we've got AI inference, we didn't even talk about, but there's potential for that. Small, let's call it 18 trillion. So some of the parts valuation for Tesla in 2035 is a mere $238 trillion. Okay.
238 trillion is crazy number because we're basically the valuation of Tesla today is 1 trillion. 1 trillion.
Yeah, and that
238 times
shows there
growth.
in the year sort of 2026 at 1.1 trillion. This is some of the parts there. Yeah.
1.3. What? 1.1. What?
Sorry, if you go up to the table to year 2025 or 2026, you can see the sum of the parts valuation numbers for where we are today.
Yeah.
2025 about 700 billion.
Yeah.
And 1.1 trillion in 2026.
Gotcha.
Yeah.
And it's going to be 238 times. And almost all of this is because of the bot and RoboTaxi a little bit more. But that's basically the key thing. The other thing I was going to mention is that this also assumes that these are the only businesses that Tesla will do.
That's right.
Once you start making bots, you can then start creating any product at this point. If you wanted to create, I don't know, Frisbees. Whatever.
Yeah. And by the way, I didn't mention this when we went through the RoboTaxi and Optimus models, but my assumption is for $41 of profit per day per RoboTaxi and per bot. $41 a day of profit.
That's it. Yeah. That's going to be way more than that. Yep. Okay.
Now, maybe in future years it'll be less than that, but 2035, I'm not convinced it's going to be way less than that. Mm-hmm. So as crazy as these numbers may look, they're actually built up by pretty conservative assumptions. And having 285 million bots in the world by 2035 again is not a stretch when we look at past success with things like the iPhone, other products. They ramp pretty quickly. But the reason at the top that we've got the probability numbers, and a little bit later we'll adjust these probability numbers, and so you can see what impact that has on these numbers. Yep. Yep. But the purpose of this was just to show the sum of the parts, and if you add those together of the existing businesses and the ones that we know that are coming, we get to a valuation, let's say by 2030 of about $48 billion, and a valuation by 2035 of about 48 trillion, and $240 trillion by 2035. Mm-hmm. Just as sum of the parts valuation. Okay. So now what we can do is just take a look at the whole company. Forget the parts. Let's look at the whole company as one entity. So in the next page, we take the profits from each of the different business lines, sum them all up, and apply just a company level PE to those profits. So for example, in 2030, we've got profits of about 538 billion. It's the total profit column there in blue right there. Yep. And so if we apply a PE ratio to that, at that point in time, let's say a 75, because you can see that profit is growing at 75% or more per year, and it has done so for 4 years by that point. So a PE of 75 at that point in time doesn't seem crazy. We get to a valuation of about 40 trillion. Now, if you recall from the previous page, the valuation in 2030 was 48 trillion using a sum of the parts. And this method gets us to about 40 trillion, just applying a company-wide PE. So the results are very similar in terms of, the actual result of the valuation.
Which is 40 times what the share price should be today.
Yeah.
40 times in 5 years.
Yeah. And that share price, by the way, a lot of people like to think of it in share prices, is the very far right column in pink, future share price. That's about 10,000 a share.
Yeah, that thing, 10,000 a share, people just gloss over. As soon as they hear somebody say, Tesla stock going to be 10,000 a share, they just, bullshit.
Yeah, and by the way, that share price takes into account dilution of the shares as well. So market cap doesn't do that. But as a shareholder, you care about how many other shares are going to be issued along the way and what your share of the profits is going to be. So that share price number actually takes that into account. We'll talk about that a little bit more in a second as well. And then by 2035, we get to a valuation of 221 trillion. And if you recall, the sum of the parts valuation was about 240. So we're in the ballpark there again. And that's using a company-wide PE of 45. And if you look at the growth rates there in that annual profit growth column in white, the company's still growing 45, 50% a year. And it has done so for a few years up to that point. So a PE of 45 or 50 at that point in time would be well warranted. Cut it in half, right? You still are over $100 trillion valuation, right? The numbers could absolutely be staggering if this company can execute on these plans. And you can see there at the bottom, the very bottom, very small numbers, percent of 2035 total, Optimus accounts for about 87% of the company's profit at that point.
Mm-hmm.
The future of this company depends on Optimus, right? The auto business is about less than 2%. Energy storage, 1.5% of the profit. RoboTaxi, 8 to 9%. And Optimus, basically the rest. And just to note, I don't know really of anybody on Wall Street that's including Optimus in their models at this point. Even ARK Invest. They've talked about it, but it's not in their numbers. The next page is just a visual of that future share price. Again, a lot of people always ask, what's the share price going to be at certain points in time? Well, if you take these model numbers, if you believed in the inputs of the model, then these would be the outputs for the potential share price in the future. Now, these aren't share prices discounted to the present. That's just in 2030, the model spits out a share price of about $10,000 a share. Again, adjusting for share dilution of share issuance to employees for stock-based compensation and things like that. Just a visual on that. And then just to sort of show people sort of what this looks like in terms of profit. If you go to the next page.
I want to stay here for a second.
Okay.
Yeah. So we are here in 2025, $392 per share, which is around.
We're less than that right now, but the model based on this valuation method gets us to about 400.
Yeah, which we jumped up to 420. It's going to be variable around that area. We can easily, some people believe, jump up to 400 by the end of this year. Yeah,
definitely.
Or fall. I mean, anything can happen. It's very sensitive at this point still. Then you're saying that by next year, the share price could be around 500 plus. So that's it's a growth. But then this is where 2027, 2028. Now we're talking, from let's say $300 to 1,500. That's a 5x. That could be a 5x by 2027.
Yeah, and then it's a 10x by 2028.
10x by 2028. I think I'm just trying to put in perspective. I invested, and I've got money here. If I just wait 3 years, maybe there's a chance, right? But I think a lot of things has to go right based on what you just listed. 100% everything, chance that they'd all work out, that it could 10x in 3 years. That's the cool part. And then in 5 years, if it all works out, it can 20x, right? 10,000 from 300, 3,000 times 3, 30x. Oh, yeah.
Yeah. Again, if you do a bottoms-up model like this, sum of the parts added up, this is what you'll see. Your assumptions may be very different than mine for each of the businesses, but this is one good way to do it. Visually, what do the net profits look like that support this?
Okay.
So what I did in the model was built it up year by year from now until 2035. And then I assumed, I believe it was a 5% growth rate in the earnings beyond 2035. Right, which I think is pretty modest. I think the company will be able to grow a lot faster after 2035 than 5%, but that was my assumption, right? And I looked at a lifetime of this company of 60 years. We saw in our previous work that we did about 6 months ago that the sweet spot for valuing a company is like 40 to 60 years. To do 80 or 100 years, it's unnecessary. The discounted value of those future earnings is kind of meaningless. And actually, if you go to the next page, you'll see that. I'm sorry, not quite. This is share buybacks. The company now has about 3.6, I think, billion shares outstanding. And by 2035, we're well over 4 billion. And over the 60-year time period for this valuation model, we get over 8 billion shares outstanding. This assumes no share buybacks. Okay, so we're factoring in share dilution is the message that I'm trying to say here in this model. The employees of the company, Elon, is going to get an increasing share of the company over time as they're compensated with stock. So as a shareholder, we're getting diluted to the tune of about 2.25% per year on average. And then this is the future earnings per share then. So we're taking the net profit number, dividing it by the number of shares, and you can see we're expecting a rapid increase from now to 2035, and then you can see that 5% kicking in, just kind of a flat line increase.
Mm-hmm. Where are we today? Earnings per share?
Where the first bar there, 2025.
About $5, like that?
Something like maybe 6.
Mm-hmm. And so this is interesting because the people because lots of people, investors, they don't like to bet on companies on future potential businesses that might come. They want to bet on it once. And then you pointed out another show that NVIDIA stocks skyrocketed after they did quarter after quarter earnings growth. Each quarter, they share their earnings per share. And then the next quarter, it was higher and it kept going higher and higher. That's when the stock skyrocketed because they go, you're proving it. You're actually proving it that you're actually getting cash in. And so this is what's interesting is that once you see these leaps in actual earnings, it can actually happen by 2026. 2027 is the actual year where you go boom, then you go boom, right? 2028. And this is why some people are saying that regardless of those who the last 5 years, stock has been flat because there's been no earnings growth. That's going to change. That's about to change. And now it's like it doesn't matter. For those people who, once you see earnings growth like this, the stock will have to rise. Will have to rise. There's none of this. What's your PE ratio? And what do you, oh my God, right? RoboTaxi is about to come. No.
Yeah,
right?
if it didn't rise in conjunction with these earnings increase, and by the way, this is a log scale, so to go from 10 to 100, right, is the same percentage increase to go from 100 to 1,000, the next section. So this is some pretty serious growth here. But if the stock did not rise along with this earnings growth, the PE would get so ridiculously cheap.
Yeah,
Wall Street can't ignore it.
You should do that. Didn't you do one time? Okay, you did do that one time. I remember you explained that NVIDIA, if you had done exactly what you just said, the PE would be $1, right?
Yeah.
Or one would be one.
Yeah.
PE 1, not 15, not 70, not 100. It's PE 1.
And by the way, what does a PE of 1 mean?
Yeah.
The PE of 1 means that it takes 1 year to pay back your investment.
Yeah.
Right? That's what it means.
The P of 1, if you had actually bought it, I don't know what the number was, but 5 years before the actual earnings came in. And so that's what you're predicting here as well. Like people are going, oh my God, Tesla's too expensive at 70, the PE of 70. Well, if everything goes right and earnings actually does flow, that PE of 70 today, right, is actually not a PE of 70 today.
And we have a chart that shows that today. So we'll be sharing that here in a minute. Now,
awesome. Okay.
What I want to do here with these future earnings is discount them back to the present, right? Because that $1,000 of earnings in 2035, it's not worth $1,000 to me right now. I've got to take into account the risk of that happening. So you discount them back to the present by whatever your required rate of return is, right? Let's say you require 14% per year. You discount that back each year by 14% and get a present value. So it turns this chart into the next one, and this represents the value of each year's earnings today. Okay?
I get it.
This shows a number of things. You can see in 2025, the value of this year's earnings as a component of the current stock price is tiny. This is why I often say, I don't care what Tesla reports this quarter, next quarter, the quarter after. It doesn't matter, because what matters is the present value of those earnings 5, 6, 7, 8, 9, 10 years out. And then after that, because I've only assumed the company will grow at 5% per year after 2035, the value of those future earnings becomes less and less and less and less, even though those earnings are still growing. And this is this is the issue I have with Wall Street, is they're so focused on the left side of this chart. They lose focus on the middle. And that is where the valuation for Tesla and all high growth stocks comes from, is that 5 to 10 year out period, or 5 to 15 years if you want to look at it that way, right? They're so focused on the quarter to quarter now that they miss the opportunity that's in this middle here.
I love it. Okay, let me explain it from my understanding, so make sure I get this, because this is important. I think this is it for me. I want to understand this. If you are willing as an investor to say, hey, what do I think the earnings of this company is going to be in 3 years, 5 years from now? Let's say 5 years. That's what we've been doing. That's why 2030 sounds great, right? So this is 2025, 26, 27, 28, 29, 30. Would be right around here, I think.
Yep, that's it.
So if that is the one, then based on your your forecast, you did a great job sharing it with me, so I don't have to do it myself, but I can tweak what you've done. If everything goes according to that forecast, then the present value of 2030 would be around 75 or $60 per share. Okay, so I can take remember the original page of the 150, and I could put in $60 per share. That's if I'm only going to do to 2030, correct?
Yes.
Yeah. But if I then start thinking,
But this is the present value of just that 1 year's earnings.
Okay, gotcha. That's what I was going to say. So I should then do 2030 plus 2029 plus 2028, like that? Okay.
Yeah.
So this is why we think, and then of course the question is, well, why just 2030? Why is it just 5 years?
Right.
That's ridiculous. Why 20? So that's where you need to decide as an investor whether or not, do you think the Wall Street guys, they don't go beyond just the next year. They don't do this kind of cash flow stuff from further out. But then the other part would be, it's also wrong for some people to go all the way out to like infinity. Maybe there should be around at least 10 years and maybe 15 years. Yeah.
You can go out to infinity, Herbert. What I'm showing here is it doesn't matter. You can go out as long as you want, but the present value of those earnings, 60 years from now, it's so tiny it doesn't matter.
Tiny, it doesn't matter. But so what do you think is the actual, as an investor, 10 years, 20 years, 30 years, what do you think you should do as a present value that you would then take the future cash flows and then bring it to a present value today?
Well, the approach I'm showing here is the one I think that is best. It also has its flaws, mind you. Nothing's perfect. And that's why so many people use PE as a shortcut.
Yeah.
And I'll show you very clearly here in a minute why that's so bad, particularly for high growth companies. But what I want to show with this chart is it's the sum of all these blue bars that determines the present value of Tesla stock today. Based on the model that we presented. Now, you may disagree with the assumptions, fine. Change the assumptions, run the model, and see what the present value is. And we're going to do some of that here in a minute, just to show people what some differences could be.
Gotcha. And this is where some people, if you agree that it's okay to do 10 years, if you do 10 years, okay, I'm going to forecast out 10 years, I'm going to bring it back down. You could get to a current present value of the stock today to be over $2,000, because this is around 300 something, and another 250, another 185, right. And you bring it down, it's around 1,500, whatever that number is, right? And that's where the justification could be. Some people will say, actually, the stock today should be worth around $1,500 today, right?
In this model, the present value of just 2035 earnings is worth more than the stock price today.
Yeah. And I think it's fair to say 10 years out. 10 years is a good number.
Yeah.
Okay.
All right. Let's talk about what you just suggested. Let's do a present value calculation. Okay. So now we're not using PE. We are taking the earnings, ideally the cash flow, but we're using earnings as a proxy here, of the company over the 60-year life cycle. And again, we looked at this earlier 6 months ago between 20, 40, 60, 80, 100 years. 60 was kind of a good sweet spot. 40 years is fine, but 60 is probably best. So let's go with 60 years. Let's assume dilution of 2.25% in shares a year. Employee compensation, Elon's compensation, over the long-term average, 2.25% stock dilution. Long-term earnings growth rate of 5%. After 2035, I have earnings growing at only 5% per year. Okay, not crazy. I'm using a discount rate this is the rate of return that I'm discounting those future earnings back. I'm requiring in the first column there 10% per year. And so $1 this year is worth 90 cents next year, right? You're discounting those future earnings. Discount rate is a combination of interest rates and the riskiness of a company. And the way to think about discount rate is, what is my required return to invest in Tesla? What kind of return would I be happy with per year to invest in a stock like Tesla? For the stock market, it's between 10 and 12%. But I showed some numbers at 14, 16, and 18 just to show what different discount rates would be. In this model, I'm assuming Tesla buys back no stock. So the buyback rate is 0. And I'm assuming that they earn 3% on their cash that they retain as from retained earnings. Okay? If you had a discount rate of 10%, the present value of the numbers in my model today is over $8,000 a share. Okay?
Oh, yeah.
If your discount rate's 18% on the far right, the present value is almost $2,200 a share. Clearly, the market doesn't agree with me. The market is not valuing the stock like this today. Okay. Just to be complete, let's look at now if Tesla starts to buy back stock. So now we've got the buyback rate going from 0, 10, 20, 30, 40. And I've set the discount rate at 12. Okay, kind of in line with the stock market. You can see that if Tesla buys back stock, it does increase the present value. The present value, if they don't buy back stock with these assumptions, is $5,500. If they do, it goes to $6,100. Again, the present value means should be the stock price today based on the assumptions in the model. So buying back stock, you can see how it would be accretive to shareholders over time. Let's look at another thing. What happens if, with the money that they retain, they can earn a better return than 3%? If they could earn 5%, the present value goes from 5,500 to 6,400. Let's say they can invest in something and earn 7%, 7,700. If they can go all the way to 11% per year, if they can compound their retained earnings at 11% per year, the present value of the stock would be almost $13,000 a share. Okay. Now, this is a bit of a tangent. We did talk about this in an episode that we did late last year. The idea here is that, and this is controversial, but I think it's gaining traction. Companies should stop buying back stock and they should purchase Bitcoin with it.
Bitcoin.
I don't want to take us on a tangent with this today, but this is the idea that's starting to gain traction.
Yes.
Okay. Now, a lot of people have a very visceral reaction to Bitcoin because they think it's tulips or a scam. It's because they don't understand it. But we're going to start to see the corporate finance world start to come around to the idea that their new hurdle rate is not T-bills, but Bitcoin. Anyway, that's enough on that today. But I just want to show people that the massive impact if they could reinvest retained earnings at a high rate and keep their capital instead of giving it back to shareholders. This next chart may be the best chart of this whole presentation. Today, Tesla's trading, let's say, at about 70 times earnings, the far left column. Based on 2025 expected earnings and a market cap of about $1 trillion, the stock's trading at about 70-ish earnings. If we take a look at, from my model, 2026 earnings, the stock's trading at about 47 times my 2026 number from the model. Kind of expensive. 27? 18 and a half times 2027 earnings. 28? 6. 29? 3. 2030? About 2. It's trading at about 2 times expected earnings in 2030. And we'll see in a minute, if we adjust these to some lower numbers, what happens. But if we go out to 2035, it's trading at 0.2 times earnings.
Yeah.
Okay, the payback period is like less than 3 months.
Mm-hmm.
The company could make enough money in like 2.5 months to justify the stock price. So this is why PE ratios are terrible for high growth companies, because the PE tells you, all the PE tells you is how long it will take to get your money back at today's current earnings. That's all the PE tells you. So if you're comparing a company that's not growing to a company that has high growth, and they both, let's say they have a PE of 20, you're comparing apples to oranges. You're comparing a no growth company to a higher growth company. In this case, you could be comparing against an extreme growth company like we saw with NVIDIA over the last few years. This is the best way that I can sort of show the mistake, I think, that a lot of people are making. They're so focused on the near term. They're missing the bigger picture about where we could be with this 5 to 10 years from now.
There are so many investors, and mostly institutional, who keeps pointing at the PE ratio. Tesla stock is too expensive. It's a 70 or 120. How ridiculous is that? And then what's worse is they'll use the PE ratio looking backwards the last 12 months. Now,
that's
some of them,
worse.
That's worse. I cannot stand that. I mean, if you look at stock tables and then you look at the PE that they report, oftentimes it's like looking back the last 12 months.
Yeah.
But okay, fine. Many of them do forward PE, but forward PE is 1 month, 1 year. Looking back, looking forward the next 4 months, 4 quarters. That's better. But even then, you laugh at that, right? You go, why just 1 year? Why are we doing a PE of just 1 year, right? And that's where that's where they just cannot fathom anything beyond a year.
If you really believed that looking at how long it takes to get your money back based on the current earnings,
all right. Yeah, that's good.
Then why would you pay 70 times earnings for any company?
You shouldn't.
No.
If you just look at 1 year,
Yeah.
right? It's like,
Right.
it's
That's
going to
all
take
that
you
it's
70
telling you.
years to pay back that earnings today. It's like,
Yeah.
I'm not, why would I do that? 70 years? I'm not going to do that. But if
Right.
it's like, well, no, don't forget that the earnings it's going to skyrocket. And then that's what you're saying. Basically, by, if I wait it out till 2030, it's really a PE ratio of 2 at that point. I mean, it's like, that makes sense. So if I'm a long-term investor, I should be looking at 2030. And this is how you explain it. This is really well done, Cern. Thank you. Yeah.
This is one of the things that bothers me the most about the way Wall Street operates. Virtually everybody on Wall Street spending their days comparing PE multiples of companies and then justifying their differences. They don't do the hard work of building up the discounted cash flow models. And the reason is, perhaps we can cue the video from Warren Buffett, Herbert. Buffett does a nice job here, although it takes him a little bit to get to his point, of explaining sort of the problem with the PE ratio.
Let's watch it.
Both of the standards you mentioned are not paramount at all in our valuation of securities. It's harder. People are always looking for a formula. And there is an ultimate formula, but the trouble is you don't know what to stick in for the variables in it. But that's the value of anything being the present value of all the cash it's ever going to distribute. But the PE ratios, I mean, every number has some degree of meaning, means more sometimes than others. Evaluation of a business is, it's not reducible to any formula where you can actually put in the variables perfectly. And both of the things that you mentioned get bandied around a lot. It's not that they're unimportant, but sometimes they can be very important. Sometimes they can be almost totally unimportant. It's just not quite as simple as having one or two formulas and then saying the market is undervalued or overvalued or a company is undervalued or overvalued. The most important thing is future interest rates.
So Buffett said a couple of very important things there, and one he glossed over very quickly, right? The value of a company is the discounted value of all the cash it's ever going to distribute.
He said all of the cash that's ever going to distribute.
Yeah. Right. And so however long you think the business will exist, you discount the value of all that cash flow back to the president.
Yeah.
The problem is, as he mentioned, there are so many inputs into a model like that, it becomes very difficult to build that. And so people they just resort to shortcuts. Now, as we saw before, at the very end, he mentioned that what really matters is interest rates. And what he's talking about is that discount rate. When we showed what happens if you change the discount rate between 10 and 18, how different the value of Tesla stock would be or any company would be. So what he could have added also, instead of saying interest rates, is growth rate of a company and the sustainability of its earnings. Those are kind of the three things that go into that discount rate, right? If I don't think a company's earnings are that sustainable, then I'm going to demand a higher discount rate to invest in the stock. If I think a company's earnings are sustainable forever, then I'm willing to expect a lower return for that, and so on. So he's touched on a couple of very important points here. And again, the reason that people don't do this is because it's too much work. But that's where the opportunity lies for investors who understand this and or who are willing to do the work. You can get ahead of Wall Street because they're only looking this year and maybe next year. They're not looking out 3, 4, 5, 10 years.
Yeah.
They won't do it.
You don't even need to be optimistic about everything or be so bullish. You can take these, I love what you always do is you put these tables out and you give variances and you can let the audience decide which one do they agree to. You can take a lot of this and you do it yourself. Okay, yeah, I don't think it's RoboTaxi's robots is way too over. Okay, cut it in half. Cut it by 3/4. Cut it by 1/10. And that's where, even if you do that, it's way more than what Wall Street is trying to tell you what it is. That's the point, isn't it?
So Herbert, let's
huge.
do that very thing, what you're suggesting.
All
right? For once, I'm actually ahead of you because I've prepared this in advance. You usually tell
Okay.
me to do the work and come back. This time I've done it. We're ready
You
for
did
that.
it.
Down to the
All
question.
right.
Okay.
Okay. Yeah, here we go.
So on this page,
Yeah.
what we did was change the probability numbers.
Nice. Okay.
Okay. So what I wanted to do was back into the roughly the current valuation of Tesla and explain what Wall Street might be thinking in terms of, if I use my model, how they might be, what kind of probability are they assigning to the different pieces.
Okay. Gotcha. Yep.
Okay. So again, I could be wrong about this, but I've done a couple of different looks at this. Here's the first one. Let's say they go 100% with my auto model.
Yep. Tesla's a car
50% of my
company.
semi model,
Yeah.
50% of my energy model, 75% of my services and other, 10% of RoboTaxi, 5% of Optimus, and they're ignoring auto bidder and inference.
Yeah, can you just explain this a little bit? Does this mean that they take your model and then they just take 10% of what you said because they just don't believe everything you're saying? Or is it there's a 10% probability RoboTaxi will even exist in the future?
No, 10% of my numbers. They divided everything by 10.
Wow.
And Optimus, they divided everything by 20.
Like, yeah, you're so off, listener. I'm just going to take 5% of your Optimus numbers. Tesla, there's so much competition out there. They're just one of everybody out there. And I'll just put 5% of what you estimate to be successful. Okay.
Yeah. So this model, then, if we go towards the bottom of the chart, we get to a valuation of about 17 trillion.
By 2035.
Okay, so from 1 trillion today to 17 trillion in 2035. And that's a share price of almost $4,000 a share.
Well, let's look at 2030. So in 5 years, it's 7 trillion, and the share price by then should be 1,650, right?
Yeah.
So which means that if it's 300 something now, it'll be 5x by 2030. So even this situation, they really should. They are also thinking the stock could 5x by 5 years.
Yeah.
Am I doing it right? Mm-hmm.
Yeah, no, that'd be one way to interpret it. Again, if they were using my model as their base, and of course they've got their own models, but I'm just sort of showing what that would look like. On the next page, Herbert, I show the present value of all this. And again, depending on your discount rate, I can get to a stock price about where we are today.
264.
Right? If I use a discount rate of 15, I get to a $300 stock price.
Yep.
With those assumptions that we just talked about on the previous screen.
Which means, if this is correct, that the reason Wall Street thinks the stock price today is about right, because they'll go on next year. I think it's going to be 350, and it's already 350 today. Yeah. So they're around. They think it's around this. That's because, and this is what they're doing though. Only 10% of what RoboTaxi could be, and only 5% of what Optimus could be. They basically are thinking of it mostly as a car company still.
Yeah. Now, on that previous screen, this one. To what Warren Buffett was talking about, how interest rates impact all this, that discount rate line. Let's say the Fed cuts interest rates by 1%. And let's say you were using a discount rate initially of 14. Now you're using a discount rate of 13 because interest rates have gone down. Now, it shouldn't be so much driven by short-term rates. You'd use a longer-term rate, maybe a 10-year treasury. Let's say 10-year treasury rates fell by 1%. If your discount rate goes from 14 to 13, then your valuation increases by about $57, $58.
That's a lot, 20%.
Right. So that's what Warren was saying in terms of interest rates matter. It does on valuation, all things being equal. You could also get a lower discount rate if the company is perceived to be more stable and higher quality and all that kind of stuff. And that's what happens too as companies kind of mature. Typically, their discount rates start to go down. So you get kind of a valuation increase on that. Certainly Apple has benefited from that, for example, and so has NVIDIA. If Tesla could somehow get a discount rate that went from 14 to 12, you could see the stock price could easily go from 350 to 480 just
That's
on that
the
alone.
Present value. No, that's
present
the
value.
present value. This is what it should be worth today.
That's right. Today. Okay. Let's look at a second example. So now what I've done is I've completely zeroed out Optimus. Optimus doesn't exist. Optimus is a failed experiment. It's not going to happen. But in order to compensate for that, in order to get present values about where they are today, I have to assume about 40% for RoboTaxi. Okay. And semi, by the way, went up to 75 instead of 50, and maybe energy storage I had energy storage previously at 50, so I've got energy storage now at 75. So I'm just kind of showing a different look in terms of how Wall Street might be thinking today. All right, if you ignore Optimus completely, with these assumptions, if you go to the next page, I can get to a present value that's about equal to today's stock price. There in that middle column, about 330 at a 14% discount rate. On these numbers, what's the PE 5 years from now? Well, if you go to the next page, the implied PE for 2030 is like 8 times earnings.
Yep.
So with today's stock price, with cutting back my model in order to get to a valuation that's equal to today's stock price, the present value is equal to today's stock price, that implies that Tesla will grow and effectively have a PE of 8 times 2030 earnings.
And that's even
So
with zeroed out Optimus.
No
today.
Optimus.
Not even considering on the Optimus.
No Optimus
and that's
forever.
because a lot of investors, we know Gary Black is famous for that. He's been saying that, well, I'm not going to put any Optimus value at all if there is no product. There's nothing being sold yet. Until they sell it with a price point, that would be when I'm at it. Meanwhile, it's just a prototype. It's just a pie in the sky stuff. That's how he looks at it. So he's putting 0% at this point. I think, well, basically, to be fair, every single institutional analyst today has put 0%. No valuation of the current forecast that they do includes any Optimus. None of them have done it yet, even though that they've done, like Morgan Stanley has done reports. Many of them are starting to do reports, but they've still refused to put the numbers in today. Yeah. That's fair.
What I have argued is that Optimus should be at least treated as a call option. Okay, fine, don't put it in your model.
Yeah.
But value it as a call option on a huge opportunity. Put some value in for that. But this model here, what we're showing right now, assumes nothing for Optimus forever. Doesn't exist.
Yeah, I love the statement you've said to me a while ago that I love, which is from the institutional investor's perspective, they think it's irresponsible for retail investors to say, oh my God, can you not see how big Optimus is going to be? Well, I'm going to give it 100% chance it's happening. We're going to own so much of the market. It's going to make so much margins, blah, 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 blah. But you said it's as irresponsible for you, institutional investor, to put 0% on Optimus.
That's right.
That's as crazy it is. It is. And I love that because, you can't say it's non-existent. I mean, how many startups have jumped in? How many companies have been pouring money into this? Have you not seen the development of the product? And, it's progressing. So the chance of Optimus is not zero at this point.
I find it extremely rich that Wall Street, which is very sophisticated when it comes to price and call options, convertible bonds, mortgages, all kinds of things have embedded options in them, that one side of the house does that in a very sophisticated way, and the other side of the house can't even think about it, right? Same company, same organization, extremely sophisticated, beyond most of us understanding in terms of how sophisticated they are with options. Believe me, on the bond desks and so on, extremely sophisticated. Yet when it comes to thinking about this and the optionality that's inherent in this business, particularly with Tesla, they will not consider it. It doesn't make any sense to me. And hence the opportunity, I think, here for retail investors to arbitrage that difference, right? It's a massive arbitrage opportunity because they are only looking for the next couple of years. You have no constraints as an individual investor. Again, do your own research. Think about this for yourself. I'm just showing a methodology here. Don't just believe my numbers. Don't take my numbers and bank it, but take this approach and think about it for yourself. You don't have to just worry about the next 2 years for Tesla. If you look at years 3, 4, 5, and beyond, you might come to a very different conclusion. That, I think, is a tremendous opportunity and a tremendous advantage that retail investors have over the Wall Street pros. And so, Herbert, the final chart is even with those sandbag numbers that gets us to a present value equal to today's stock price. Here's the PE that you're paying on 2030 earnings is about 8 times earnings.
Yep. Yeah. So P is dumb. If you're like going, somebody goes, it's $80, $120 P, 120, not $80, 80 PE, 120 PE. That's ridiculous. Tesla's overvalued. If you just sandbag what you think, like no optimists, just 40% of RoboTaxi and everything sandbag like the way you did it, the PE ratio really today is $8. It's not, I keep saying bucks, 8. The PE ratio is 8.
8 times 2030 earnings.
It's crazy.
And I would say this,
Yeah.
that even if you insist on using PE, don't just tell me what the PE is on this year's earnings.
Mhm.
Tell me what the PE is on 2030 earnings. Tell me what the PE you think it is on 2035. Give me the range of PEs like we see on this table. Why are they only telling us the PE for 2025? That's 1 year. Who cares? The company's going to exist much longer than 1 year. At least give me the PE that you think it is trading at on 2030, 5 years from now.
Yeah.
No one on Wall Street does that.
Yeah. Exactly.
Right? Like, I'm willing to meet you in the middle. Like, tell me what you think the PE of this company is on 2030 earnings. Fine. Well, we can stick with PE in that case. But give me that number, not the useless one of this year. The short-term thinking is actually kind of insane. It doesn't make sense. You're investing in a growth company that's growing beyond 1 year, and yet you insist on focusing on just on the next year or two. There's a major disconnect with that. And so I could use stronger language, but PEs are dumb.
PEs are dumb. Yeah. And too often they'll say, earnings, don't you know what earnings are going to be next year? Yeah, I get it. Earnings are flat. Auto business is flat. So don't invest in Tesla.
Yeah.
Okay.
And I guess offsetting this a little bit is they say, well, we would rather invest in companies that are working and producing earnings today.
Mm-hmm.
Like, we'll come back to Tesla when it starts to, produce the earnings that you're modeling in this model. That's fine. They can do that. They can try to time all this if they want to. Again, retail investors don't need to play that game.
Well, what happens is RoboTaxi and bot, they put 0. And then all of a sudden, RoboTaxi is a real deal. And some people think, let's say, that RoboTaxi expands to 3 cities. When that moment happens, every single one of these institutional analysts, everybody, all investors now they're forced to forecast now. Then it brings it back in, and then they realize, oh, crap. Even if I put 40% of Cern's numbers and I just sandbag everything he did, yeah, it's so significant that I do need to, like, everything just jumps at that point. And so that's why, that's why you do see the stock go flat, and then all of a sudden, boom, jumps. It jumps 20x because it catches up to some new business that they did not measure at all to now they do. So that's why I really like your model, which is add probabilities, and then you bring that back into today's value. So if I'm buying a stock at 300, and again, not financial advice, because who knows what stock price is going to do in the short term, but I expect, at some point by 2030, I do think it's going to be over $500. Looks like it, right? Just take a look at the lines of business that you just mapped out and sandbag it.
Yeah, there's lots of different approaches to doing this. Using a simple PE on this year or next year's earnings is dumb. Don't make that mistake. This is just that chart that shows the future share price based on this model with the sandbag numbers and how it moves up. Again, it moves up in line with earnings growth. As earnings make those stair-step climbs, the stock price would as well.
This is 0 optimists, 40% RoboTaxi.
Correct.
Of your numbers.
Yeah.
And even then, if you have a 3-year outlook from now to 3 years from now, 2028, even with your sandbag things, the stock price at that point should be 1,800, which is 5x today.
Yeah. Yeah.
Which is fair, because even if you did add RoboTaxi robots, it's still too small in 2027, 28 anyways.
Sure.
Yeah.
Yeah. No, that growth of that really kicks in sort of the early 2030s. Now, if you're looking at this chart and saying, okay, well, the real growth isn't going to occur until 27, 28, I'll stay out of the stock until then.
Yeah.
Well, Wall Street, to their credit, does look ahead a year or two. So that 2027 number could get pulled forward a little bit. And that 28 number could also get pulled by, 12 or 18 months forward. Right. So please don't misinterpret what I'm showing here. I'm not suggesting the stock's going to be at 1845 in 2028. That's a number that would be justified by the earnings of the company at that point. But from an expectation standpoint, that could come sooner. As myopic as Wall Street is, they do look be on their toes by a foot or two,
Yeah.
just not, by a few hundred feet. So hopefully that's helpful in terms of talking about valuation. Valuation is a very complicated topic. As we've mentioned, people shortcut it by just talking about PEs. But don't lose sight of what the PE is. All it tells you is how quickly you're going to get paid back based on today's earnings. It tells you nothing else. It doesn't tell you about the growth of the company. It doesn't tell you about the shape of that growth. So just be careful. Be a bit more thoughtful about valuation than just using a PE multiple.
Okay. Let me summarize what I think I'm learning today. So first of all, it looks like that the general institutional analysts, what they like to talk about a lot is PE ratios. Right. So that is how they will say this is the valuation of this company, whether or not they think that the stock price is expensive or not. Unfortunately, they do a PE ratio of just, let's say, 12 months forward, a forward PE ratio of 12 months. And they're going, the earnings aren't there yet. That's too expensive. It's ridiculous. Then there's others who will do some of the parts. And when they do some of the parts, I think Dan Ives, I had him on a show one time, and he debated very directly with Gary Black. Gary Black is very much the PE ratio guy. Show me earnings, and only when earnings, that's well invest. And my argument to Gary is that you're really a value investor. You have no business investing in Tesla. Tesla's not the kind of company for you. You need to be looking at companies that has the earnings and growing the earnings. If you don't believe in these stories, as you call them, they're just stories at this point until they become real. Okay, so he does PE ratios. Dan Ives does some of the parts. But what I had understood when they said I do some of the parts was you take out all the businesses and you would actually map out what you think the earnings would be, and you do discounted cash flow down. And that is the way that most of us retail investors, analysts, the retail analysts, they do this. They do the work like you, AJ, James Stevenson. There's a bunch of people who've created a forecast and said, okay, and do a lot of assumptions and saying, if this is what they price it at, this is their margin, this is what their market penetration is, this is successful, and then I'm going to put a discount like, yeah, maybe it's not going to be successful this year, maybe it won't ever be successful, but I'll put like you said, some sort of probability. Mm-hmm. You take the potential future cash flows, you bring it back to what it could be, to what its price should be today, but also what the price should be 3 years from now, 5 years from now. Okay. That's discounted cash flow, which I think we all think that that's the better model. Mm-hmm. But then the sum of the parts, I always assumed was you take that discount of each of the different businesses and bring it down. And what I think you just told me earlier part of the show was that, no, a lot of them do, when they call sum of the parts, they're still using PE.
Yeah, they might use PE, or for a business that maybe doesn't have earnings, they might use a price to sales multiple or some other multiple, right? And we see this. So they're all forms of a PE. They're all some ratio that's just has the same issue that a PE multiple has, right? And so they often resort to shortcut methods. The only method that's valid for figuring out the true value of a company is to discount all future cash flows, which is, by the way, when you value a bond, is exactly what you do with the bond. Now, a bond has an advantage because you kind of know what the future cash flows are going to be. When you buy a treasury bond, you know exactly what the government's going to pay you every quarter, right? With an equity, you don't. And so because that's so difficult, because there's too many unknowns, people resort to the shortcut methods. And I'm here to say that those shortcut methods lead most investors astray, and massively so when you're talking about a high growth company.
There you go.
That's my main point.
The shortcut methods could work if you're Coca-Cola or you're PG&E or something like that, where you can, the growth is so small. But
if you're
it's
going
a high
at
growth
3
company,
or 5% a year, fine, use a PE multiple. That's not going to be a problem for you.
Yeah.
But if you're growing at some point by 100% or some crazy number,
because you've disruptive innovation, you've created something that's just going to completely blow away. You're just you cannot put zero potential for that. Yeah, got to put some. Yeah.
And if you don't believe me in terms of what I'm saying here, go back and look at NVIDIA and see what happened to them.
Which we did a show one time. That was a very good show. If you take a look what happened to NVIDIA, Cern mapped it all out, because he kept saying, oh, one day we're not going to just do gaming GPUs. We're going to be doing AI GPUs. No, nobody believed them. I said, sure, Jensen, sure.
Right.
And then even when the ChatGPT moment happened, people said, sure, Jensen. But then when he did quarter upon quarter earnings, that's when stock had to catch up and do that. But if you did listen to him, which is like some of us doing now with Tesla, the years before, we would see right through the PE being 70 or 100. We'd go, no, actually, it's PE 1. Like you actually, when you look back retroactively based on what happened in NVIDIA, PE was 1.
Right. And if you had any kind of foresight, what an opportunity that was.
Yeah,
and what I'm seeing is the setup is potentially very similar, if not even better, for Tesla.
Yeah. Yeah.
But again, do your homework, please. I'm presenting kind of a way of looking at this, and I encourage everybody to put their own pen to paper and figure out what their assumptions are. I could be very wrong about where Tesla's auto deliveries are in 2035. Who knows? But use your own numbers and see what you come up with.
Yeah, so I think it's worth noting that this is not financial advice because we have no idea. Each person who's listening has very different scenarios, very different goals, very different objectives, timeframes, money scenarios, all that stuff. And so we would not want to tell you, must buy Tesla today. You're going to get rich now. I don't know. We've seen the Tesla stock flat for 5 years. And, but that's what investment is, right? It's like you're trying to find a company that you think is going to be successful for whatever thesis you have. And then you're watching those products and business come to life or die. And then, but you should do the work. That's the whole point about investing. And this is why you help us do that. Thank you so much, Cern. This is one of the big shows. I love this. It's valuation is always the sticky part about any stock, really. And then it's like you just said now, it just gets so off when you're talking about companies specifically that are innovative companies, that are growth companies that are supposed to grow. But if it doesn't grow for this year, this next year, that's when everybody goes, the stock sucks. But if it happens, it will jump.
Yeah. And Herbert, the final thing I would say on this too is that the revenue and the earnings is the last thing that happens for a growth company. In order to get the revenue and the earnings, they've had to invest for years. So it starts with a story. It starts with Elon saying, we're going to build RoboTaxi. We're going to build humanoid bots.
Robots. Yeah.
Right. And then you see them invest in this over the years. And so at some point to ignore it, again, as I've said, I think it's irresponsible to ignore it because you're seeing them make the investments. Look at the investments they're making in AI and compute, right? And the last thing that happens is when the revenue earnings hits the books. So if that's what you're waiting for, you are definitely going to miss this, right? You're definitely going to miss it. Now, the good news is it's not like the earnings hit in one quarter and that's it. They're done growing. That's the start, and then they'll grow from there. So it's just a degree to which you want to be conservative about these things.
Or risk averse. Willing to take on risk. Yeah. If you want to get in there when there's just a story and then you're hoping to get a 10x, maybe you can do that. But some people, no. I'm only going to do it if my risk is lower. So I'm going to wait until the earnings go. That's perfectly fine. You can do that too. Yeah. That's great. Cern, you're the best, one of the best Tesla retail analysts. You put in the work and you help us rethink all this. Very, very helpful to the retail community. Thank you so much, Cern. Follow him on his X account, Cern Basher. Check out his website, BrilliantAdvice.net. Thanks, everybody.
Thanks, Herbert.
I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.